If you want to invest in stock market, then in this video, I'll introduce you to index mutual funds, which can be an amazing option to consider. Warren Buffett says index funds are best for long-term investors. Basically, every person has three questions when they start or they try to get stock market investing. Number one is, God hell, which stock to buy? What metrics should I use to find a good stock? Number two, it is, if we buy that stock, should we buy the same stock every time we invest, every month? And number three, it is, how to split my investment amount to maximize my returns. Now, to answer these, let's find out what are index funds, how do they work, index funds versus mutual funds, and finally, how to invest in index funds. So, what is index fund? Index fund replicates the performance of a particular index, such as Nifty or Sensex. The portfolio of these funds consists of only those stocks that represent the index according to weightage assigned to each stock by stock exchange based on market capitalization. Hence, the returns from these funds are equal to those generated by index, and it moves exactly with the index performance. Now let's understand this with a simple example. Suppose you have to buy sweets and you go to a sweet shop. You're confused that which one is better, and there is so much variety available. It is too much risky that if you buy one entire box of one sweet and it turns out to be So in that case, what we do is, there are many sweets, we'll ask the shop person to give us different sweets packed in one box. One piece of motichur laddu, 2 pieces of kaju katli, 2 pieces of mango barfi, and 2 pieces of rasmalai, and some mixture for that crispy and spicy taste. So there is minimal chance that it will go waste, as we have different variety and you can select and eat whatever you want. Now, a sub to the channel would be Investly Smart Trade. Similar way, this is how index fund works. When we buy an index fund, we put small shares, which is quantity of shares of all sectors in it, and make a portfolio out of it. If we see Nifty 50, it has 50 shares of top leaders from all the sectors. Similarly, in Sensex, we have 30 shares from different sectors. Now, if you want to know more about Sensex and Nifty, do check out this video. I'll put it in I button. How do index funds work? Now, when you put money in an index fund, that cash is then used to invest in all the companies that make up the particular index, which gives you a more diverse portfolio than if you were buying individual stocks. Let's use Nifty 50 as an example. The Nifty 50 is one of the major indexes that tracks the performance of 50 largest companies in India. Investing in a Nifty 50 fund, one of the most popular, means your investment are tied to performance of 50 companies. The goal of index fund is to mirror the same holdings of whatever index they track. They are naturally diversified and thus hold a lower risk than individual stock holdings. Now, market indexes tend to have a good track record too. Though the Nifty and Sensex certainly fluctuates, it has historically generated nearly about 12% of average annual return over time for investors. Just remember that future returns are not guaranteed. As they say, mutual fund investments are subject to market risk. Read all scheme related documents carefully before investing.
A few moments later.
So index fund is a form of passive investing, meaning investors don't need to actively manage the stocks and bonds investment as closely, since the fund is just copying a particular index. Remember, our teachers used to say copying is bad and you will be taken to principal and punished. Here, copying is considered as good, and instead of punishing, you will get rewarded by market returns. And of course, you don't have to go to the principal. Now, to differentiate index funds versus mutual funds are actively managed by fund managers who choose your investments. The goal with mutual funds is to beat the market, while the goal with index fund is to simply match the market performance. Since index funds don't require daily human management, they have lower management cost called expense ratios than mutual funds. The money saved in fees by investing in an index fund over a mutual fund can save you lots of money in long term, and in turn help you make more money, which boils down to save money and money will save you. To invest in index funds, I personally use Coin, which is by Zerodha, which is so simple and easy to use. Once you register yourself by details providing, then go to home, and here you will see all the index funds. Now, some things to keep in mind or to watch out for when buying index funds. Number one is, just look for any index fund that has low expense ratio, meaning less fees to manage your fund. Second is, just look that if you invest in it, That fund doesn't allocate much to cash. As investment is more in cash, you will get less return on it. And finally, it should have the least possible tracking error, meaning that fund should follow the market. Index as accurate as possible. Also, tracking error of any fund can't be zero. Just look out for minimal ones. Now, if you got to know about index funds, do consider sharing with your friends and family. Really appreciate it. Until then, my name is Vishal. Thank you for watching. I'll catch you in the next.